The diminishing value method for calculating the decline in value for a capital allowance deduction is set out in section 40-72 of the ITAA 1997. We can use the diminishing value method to calculate the decline in value for assets held post 9th of May 2006, noting that assets held prior to this date may be eligible under section 40-70. The method is not available for intangible assets except for copyright in a film, for example, in-house software or intellectual property. Let's consider Glenn and his small sheet metal business, Metal by Hand. In the income year just ended, Metal by Hand purchased an item of machinery with an effective life of 10 years. On the 1st of September this income year ended, the machinery was installed. The purchase cost was $90,000, and this is the first element cost. On the 1st of May, capital improvement works were undertaken at a cost of $10,000. The formula to use for the diminishing value method is set out in section 40-72, subsection 1, and is the base value multiplied by the number of days held in the year divided by 365, multiplied by 200% divided by the effective life. So what this is a reducing balance method without a residual value. The 200% factor means twice the rate of decline in the first year compared with the prime cost method. However, the size of the decline reduces in subsequent years as the balance gets smaller. No more than the cost is recovered over time. So in our example, the base value in the first year is $90,000, being the purchase price, plus the $10,000 capital improvement, which is a second element cost. Cost is $100,000. In subsequent years, the base value is the opening adjustable value plus second element costs for that year. So in the first income year, the base value is equal to the purchase cost of $90,000 plus the $10,000 capital improvement cost. The days held is the number of days from installation on the 1st of September to 30th of June, which is 304 days, which we divide by 365. Note that leap days must be included in the days held if we're in a leap year. And then we multiply by 200% divided by the effective life of 10 years. This gives us a decline in value of $16,657. We then deduct this from the base value to give us the adjustable value of $83,343 at the 30th of June. Now, in the next income year, we have a further capital improvement made on the 1st of August costing $5,000. But we also have a review of the effective life, and based on rapidly changing technology, the effective life is reviewed downwards from 10 years to 5 years on the 1st of June. So for the second income year, our base value is the opening adjustable value of $83,343 plus the $5,000 second element cost, which is $88,343. The asset was in service for the full year, so we multiply the base value by 365 divided by 365, and then multiply by 200% divided by 5. Note that we've changed the effective life to 5 for the calculation for the entire income year, even though the review did not take place until the 1st of June. So, the decline in value is $35,337, and our new adjustable value at the end of the second income year is $53,006. To recap, some of the key points for you to note are that most intangibles are not eligible to use the diminishing value method. Second element costs are not depreciated separately. They form part of the base value in the formula used to calculate the declining value at the end of the income year. And any changes to the effective life during a year affects the calculation from that year onwards, regardless of when the change occurs. That is, that there is no pro rata decline calculation for part of the year.